Imagine you're walking onto the floor of a massive neon lit casino in Las Vegas.
Oh yeah, the loud carpets and everything.
Exactly. The carpets are incredibly loud. You've got people screaming around the craps tables. Chips are flying everywhere. Bells ringing from the slot machines.
Total chaos.
It is absolute unbridled chaos. And you know, when most people think about global financial markets, that is the exact image they have in their heads, right?
They picture the day traders and the crazy swings.
Right. The wild intraday swings, the fortunes being made and just completely vaporized in a single afternoon trading session. But if you look beneath that casino floor, down in the sub-basement, where it's, you know, quiet and sterile and perfectly climate controlled, there's an engineer.
Just quietly running the whole thing.
Exactly. An engineer in a gray suit checking the water pressure, routing the electricity, and collecting a tiny fractional fee for every single watt of power and every single drop of water that goes up to that casino floor.
And that engineer, I mean, they don't care if you hit blackjack.
They really don't. And they certainly do not care if you go completely bust. They get paid either way every single day because they own the plumbing.
The underlying infrastructure.
Right. So for our deep dive today, we are going straight into the basement of the global financial system to look at the Q2 2026 earnings print for Intercontinental Exchange, ticker symbol ICE.
It's a fascinating quarter to dig into.
It really is. Our mission here is to strip away the corporate fluff and see how a massive $5.7 billion acquisition is re-engineering the credit markets. We're going to look at how AI infrastructure is just eating their capital expenditures and what this specific quarter signals for you if you're holding the stock or thinking about buying it.
You know, the plumbing metaphor holds up perfectly here because the architecture of that basement, it's undergoing a massive structural upgrade right now.
Yeah, let's get right into that.
If you really want to understand Intercontinental Exchange today, you have to look at how they're widening those pipes, accelerating the throughput, and, you know, fundamentally changing the types of assets flowing through them.
Right. It's not just about keeping the lights on anymore.
No, not at all. This Q2 report isn't a story about a company simply facilitating trades. It's really a masterclass in engineering all-weather structural growth.
All weather is the key word there.
Exactly. They are building this infrastructure monopoly that basically isolates their cash flow from the cyclical panic of the broader market.
I want to look at the scoreboard right away because the composition of their revenue is super telling. So adjusted EPS came in at $1.90.
Which is their second best quarter in history, by the way.
Right, second best ever. With net revenues hitting $2.7 billion. The number that I think defines the entire IC thesis right now is the $1.4 billion in record recurring revenue.
Yeah, that's a crown jewel.
It is. That's up 8% year over year. For an exchange relying on recurring revenue rather than transaction volume, that is a radical departure from the historical model, isn't it?
Oh, completely. I mean, historically, operating a financial exchange meant riding a wild cyclical beast.
The boom and bust.
Right. Exchanges thrived on episodic volatility. If there was a geopolitical shock or a massive surprise in the non-farm payrolls, trading volumes would just explode.
And transaction revenues would spike right along with them.
Exactly. But when the VIX collapses and markets go dormant, those transaction fees just evaporate. It creates a brutal cycle for capital allocation.
Because you never know how much cash you're actually going to bring in next quarter.
Exactly. You can't plan. But over the last decade, ICE has systematically insulated themselves from that volatility.
So that $1.4 billion in recurring revenue, what exactly is that made of?
It represents the subscriptions to their proprietary data feeds, the licensing of their fixed income indices, and the core connectivity fees that, you know, asset managers and banks pay simply to maintain their network access.
They're essentially acting like a commercial landlord.
That's a great way to put it.
Like, you want to run a high-frequency trading strategy. Pay the rent for the server space. You just want to passively observe the evaluated pricing of municipal bonds. Pay the rent for the data feed.
They're collecting rent on every interaction.
Right. And if I'm looking at this from a valuation perspective for you, the investor, Wall Street usually pays a massive premium for earnings visibility.
Predictability is everything.
Yeah, when you have $1.4 billion hitting the balance sheet on the first of the month, regardless of whether the S&P 500 is up 5% or down 10%, that completely changes how aggressively management can deploy capital.
It changes the entire cost of capital and really the strategic timeline. Management actually highlighted on the call that this 8% growth, it's compounding on top of the records they set last year.
Which compounded on top of the year before that.
Exactly. Which compounded on top of the structural growth they achieved back in 2020. It's this cascading effect.
So they aren't just hoarding cash.
No. When you aren't hoarding cash just to survive a dry spell in trading volumes, you can actually play offense. You can take that reliable rent money and go buy more real estate to expand the empire, right, while your competitors are stuck playing defense.
Which brings us directly to the $5.7 billion elephant in the room, the all-cash acquisition of MarketAxess.
Yeah, this is a huge move.
Massive. They are paying $167 per share, which is a 33% premium over MarketAxess's closing price right before the announcement. Let's really look at the mechanics of this, because the fixed income market is not like equities at all.
Oh, it's a completely different universe.
Like, you can't just route a corporate bond order to a exchange and get instantaneous execution, right? It's a fragmented mess.
The structural difference is profound. I mean, in the equity market, liquidity is centralized and the instrument is standardized. There is only one flavor of Apple common stock.
Right, a share is a share.
But the bond market is this sprawling, opaque wilderness of over-the-counter instruments. A single corporate issuer might have 50 different bonds outstanding.
All with different terms.
Exactly. Different maturity dates, different coupons, different covenants, and different positions in the capital structure. We are talking about millions of distinct fixed income instruments globally.
So how do people actually trade them?
Well, historically, if a pension fund wanted to buy a specific tranche of corporate debt, they used this archaic request for, quote, or RFQ process.
RFQ, yeah.
They literally had to call or message 3 different dealers at major banks and ask for a price.
So the single greatest barrier to entry in fixed income is just finding the other side of the trade without signaling your entire strategy to the market and moving the price against yourself.
That friction of finding liquidity is the ultimate tax on returns.
Yeah.
And ICE has spent years attacking this friction, but mostly from the periphery.
What do you mean by the periphery?
Well, they built a colossal data business that provides daily evaluated pricing on over 3 million fixed income securities.
So they have the pricing data.
Right. If a specific illiquid bond hasn't traded in 3 weeks, ICE's algorithms calculate its fair value based on observable inputs from correlated assets.
Oh, wow.
Yeah. Then they built ICE Clear Credit, which totally dominates the post-trade clearing of credit default swaps.
Okay, so they have data and clearing.
And they also built ICE bonds, aggregating retail and wealth management flow, like the trading desks at places like Charles Schwab and Fidelity.
Yeah.
But they always lacked the central hub.
Which is what?
Deep, direct execution access to massive institutional asset managers.
Ah, okay. And MarketAxess gives them those 2,100 institutional firms.
Exactly.
But wait, let me push back on this a bit. MarketAxess has been bleeding market share to Tradeweb recently. Their fee capture per million has been compressing.
That's true. They have been losing ground.
So ICE is paying a 33% premium for a business that is fundamentally losing its grip on the institutional credit market. Sounds like catching a falling knife. How does plugging a declining execution venue into ICE's existing infrastructure magically reverse that user defection?
It's a fair question. The math on that 33% premium only works if you look at the total cost of ownership for the institutional asset manager.
Okay, break that down for me.
The analysts on the call were incredibly focused on this exact friction point. Like, why is ICE the natural owner here? And it comes down to collapsing the technology stack.
Collapsing the stack.
Right. Right now, a portfolio manager's workflow is completely disjointed. They pull pre-trade pricing data from an ICE terminal. Then they execute the RFQ on MarketAxess. Then they run post-trade analytics through a third-party risk system. And finally, they route the clearing to yet another venue.
That sounds like a nightmare.
It is. Every single hop between those systems introduces latency, reconciliation errors, and separate licensing fees.
It's basically an impedance mismatch between the data layer, the execution layer, and the clearing layer.
Precisely. ICE is acquiring MarketAxess to eliminate all those hops. They are taking a standalone execution venue and embedding it inside a comprehensive front-to-back ecosystem.
So a one-stop shop.
Exactly. Management laid out the calculus on the call. Better integrated liquidity plus superior proprietary data equals higher transparency. And that transparency drives better execution quality at a lower total technology cost.
Oh, I see.
If ICE can walk into BlackRock or Vanguard and offer pre-trade analytics, seamless execution, and automated post-trade clearing on a single unified rail, they don't just win back market share, they completely change the fundamental market structure.
Which is why management kept referring to the classic ICE flywheel during the call.
Yes, the famous flywheel.
I mean, we hear flywheel thrown around by literally every tech startup in Silicon Valley, but in market infrastructure, it actually has mechanical validity. How does integrating market access specifically accelerate that compounding loop for ICU?
Well, market infrastructure, the flywheel is driven by the gravitational pull of liquidity and data.
Okay.
First, by merging ICE's retail liquidity pools with MarketAxess's institutional network, you concentrate global liquidity. And traders are highly pragmatic, right?
Right. They just want the best execution.
They route orders to wherever the deepest liquidity sits to minimize slippage. So that's step one. Second, as more execution flows through this unified network, ICE captures an unprecedented mountain of transaction data.
And data is gold.
Absolutely. Third, that high-fidelity transaction data feeds directly back into ICE's continuous evaluated pricing engine and their pre-trade analytics.
Which makes the analytics even better.
Exactly. Fourth, those analytics become exponentially sharper because they are ingesting the highest quality proprietary data in the market.
Which essentially forces the asset managers who left for TradeWeb to come back. Because if they don't subscribe to ICE's analytics and trade on ICE's network, they're operating at a massive informational disadvantage.
They will literally underperform their benchmarks because they're trading blind.
And that completes the turn of the wheel. The barrier to entry for competitors just becomes insurmountable. I mean, a fintech startup cannot replicate decades of historical pricing data, nor can they magically integrate 2,000 institutional firms into a bespoke clearinghouse.
No, it's impossible. ICE is building a walled garden around the entire life cycle of a bond.
Now, this aggressive consolidation strategy isn't happening in a vacuum. The macro environment is creating massive structural demand for ICE's existing hedging products. I want to shift gears to the rates business, which grew a staggering 24% year over year.
That 24% is a huge number.
It's massive. Total futures and options open interest hit a record 53 million contracts in June. We need to dissect this because why is open interest the metric that matters here rather than just daily trading volume?
It's a crucial distinction. Volume is noise, but open interest is structure.
Explain that.
If I buy a Euribor contract at 9 a.m., sell it at 10 a.m., and buy it back at noon, I generate significant volume, right?
Right.
But the net risk held in the market hasn't changed at all.
Yeah, you're just day trading.
Exactly. But open interest measures the total number of active, outstanding contracts held by participants at the end of the trading day. It represents committed capital.
So it's money staying in the system?
Yes. When open interest surges to 53 million contracts, it means massive financial institutions are putting real directional risk onto ICE's balance sheet and holding it there to hedge their exposures for months or even years.
It proves structural reliance on the platform, not just speculative day trading.
Precisely.
So what is forcing these institutions to hold 53 million contracts right now? What is the specific macro catalyst driving a 24% explosion in the rates business?
Basis risk. Specifically basis risk driven by central bank divergence.
Okay, unpack that for us.
We are witnessing the fracture of the synchronized global monetary policy that we saw over the last decade. The European Central Bank, the Bank of England, the Swiss National Bank, and the U.S. Federal Reserve. They are all operating on completely different timelines with varying inflation dynamics.
Right, they aren't moving in lockstep anymore.
Exactly. So if you're a massive multinational, say, Airbus, you're manufacturing in Europe, selling in dollars, and sourcing components priced in sterling, you are suddenly exposed to violent fluctuations in the cost of capital across multiple jurisdictions.
And the spread between these differing interest rates is highly volatile.
Yes.
I mean, you cannot operate a global supply chain if a 50 basis point divergence between the ECB and the Bank of England completely wipes out your operating margin for the quarter. You absolutely have to hedge that cross-currency exposure.
And ICE operates the dominant multi-currency platform where you can hedge Euribor, sterling, and Swiss franc risk simultaneously.
Simultaneously being the key word.
Right, because the capital efficiency here is the true moat. If an institution clears their euro swaps at Eurex and their sterling swaps at LCH, they have to post gross initial margin at both clearinghouses.
That ties up a ton of cash.
Exactly. But if they clear both through IC, the clearinghouse calculates the correlated risk and provides portfolio margin offsets. They save billions in locked-up capital. The total value of positions across ICE's main European and UK rates contracts hit $62.3 trillion in mid-June.
Wait, 62.3 trillion?
Trillion, with a T. It has tripled in 3 years, completely surpassing the comparable market tied to US dollar rates.
That number almost breaks the human brain, but this ties directly back to MarketAxess, doesn't it?
It does.
Because IC dominates the hedging of European interest rates. By acquiring MarketAxess, they are getting their hands on a rapidly growing U.S. Treasury trading platform. They are basically taking this exact same clearinghouse efficiency playbook and deploying it into the U.S. sovereign debt market.
Management explicitly stated this is the roadmap. They are connecting the MarketAxess Treasury execution layer directly into ICE's newly approved Treasury clearing system.
So they're replicating the European model.
Exactly. They're replicating that end-to-end European ecosystem right in the middle of the U.S. government debt market, just as new regulatory mandates are forcing more Treasury clearing anyway. It is a highly calculated expansion.
Amazing. Now, the divergence causing all this basis risk isn't just happening in central banking. It is happening in global supply chains, which showed up in their energy markets data.
Yeah, the energy complex is fascinating right now.
Energy volumes were slightly softer compared to the extreme volatility of Q2 last year, but the underlying structural shifts are massive. The geopolitical map is being redrawn, and ICE is essentially the toll collector on the new trade routes.
The rewiring of global energy flows is permanent at this point.
Yeah.
The reconfiguration of European energy following the loss of Russian supply, that turned ICE's TTF natural gas contract into the undisputed global benchmark.
Right.
And now escalating tensions in the Middle East and threats to critical shipping lanes like the Strait of Hormuz are forcing the market to fundamentally reevaluate physical delivery risks.
Management actually specifically highlighted a migration in liquidity toward their Dubai crude contract, moving away from physical benchmarks.
Because when the physical transport of oil becomes a geopolitical hazard, market participants demand cash-settled instruments.
Makes total sense.
You don't want to be caught holding a futures contract that requires you to take physical delivery of oil at a terminal that is currently blockaded.
Nobody wants that headache.
Right. ICE's Dubai crude contract is cash-settled and prices a basket of Middle East grades. It's trading aggressively alongside their flagship Brent crude contract.
So they own the benchmarks.
ICE doesn't just manage Brent anymore. They control the pricing network, connecting Brent to Houston, to Western Canada, and to roughly 800 regional oil and freight markers globally. They command 90% market share in those regional markers.
So basically, if a barrel of oil moves anywhere on Earth, ICE captures the data and monetizes the hedge.
Pretty much.
They also noted that options trading in the energy complex is growing 4 times faster than futures trading, now making up 40% of their energy open interest. Why are options suddenly dominating the energy hedging strategy?
Well, a standard futures contract is a linear, blunt instrument. It locks you into a specific price.
Right.
But options provide non-linear protection, which is absolutely essential when the risk surface is incredibly complex and long-dated.
Can you give an example of that?
Sure. Think about an airline hedging jet fuel. They need customized optionality to protect against sudden geopolitical price spikes, but they don't want to lock in a floor if prices happen to collapse.
They want the upside, but protection on the downside.
Exactly. Management pointed out that over half of the open interest in their energy complex sits more than 6 months out on the curve. This is institutional capital locking in the economic reality for 2027.
And options require sophisticated margin calculations, right?
Yes, deep commitment to the exchange's risk models, which makes that revenue incredibly sticky for IC.
This brings us to a totally different segment, the mortgage division, ICE Mortgage Technology.
This is where things get really interesting with AI.
Yeah, they processed 10.7 billion API and web calls in Q2, which is up 39% year over year. The mortgage market has been absolutely gutted by high interest rates, yet their API usage is exploding. This is where we have to dig into IC Aurora and how they are deploying AI. And just to be clear, this isn't some Silicon Valley startup wrapping a Chat GPT wrapper around a PDF reader.
No, not at all. IC is weaponizing artificial intelligence to eliminate massive, labor-intensive back-office bottlenecks in housing finance.
Oh, so?
ICE mortgage technology operates Encompass and MSP, which effectively function as the network of record for the U.S. mortgage industry.
Right, they own the rails.
Nearly 9 out of 10 mortgages in America touch their infrastructure at some point. From loan origination and income verification to packaging the security and servicing the rights, all that data flows through IC.
So they possess basically the largest proprietary closed-loop data set of American homeownership.
And that closed loop is critical. What IC Aurora does is deploy AI agents directly into the deterministic workflows of Encompass.
What are these agents actually doing?
These agents automate service ordering. They run complex fee calculations based on hyperlocal municipal tax codes. They generate dynamic legal disclosures and handle escrow reconciliations.
That's a ton of manual labor replaced.
Exactly. And on the servicing side, their AI voice assistants are resolving complex inbound inquiries from homeowners regarding amortization schedules and escrow shortages, entirely bypassing human call centers.
Think about that. In a 7% mortgage rate environment, origination volume is virtually dead. Lenders are bleeding cash.
They're desperate for margin.
If ICE Aurora can automate 30% of a bank's back office operations and eliminate all that call center overhead, lenders really have no choice but to buy the software. Efficiency is literally the only product that sells in a housing recession.
Exactly. ICE is expanding their market share and winning new enterprise logos right in the middle of a brutal macro environment because they are delivering immediate, quantifiable cost reductions.
But, and there is a big but, here, building out that AI capability requires an immense amount of capital, which brings us to Section 3, management guidance.
Yeah, the guidance was a big talking point.
The revenue guidance was incredibly strong. Fixed income and data services recurring revenue growth was upgraded to 7 to 8%. And exchange recurring revenues are projected to grow in the high single digits. But the expense side of the ledger is where Wall Street usually panics.
They hate seeing costs go up.
Adjusted operating expenses were raised to a range of $4.11 billion to $4.2 billion. And more importantly, they pulled forward roughly $850 million in capital expenditures from 2027 into 2026.
Yeah, Wall Street analysts usually have an allergic reaction to unexpected CapEx.
I mean, the standard playbook dictates that you expand margins by keeping costs flat while revenues grow.
Right. When a management team announces a massive acceleration in spending, it usually signals bloat or a desperate attempt to buy growth.
But ICE management fiercely defended this $850 million pull forward, right?
They did. They said it was essential capacity building, entirely driven by client demand for AI infrastructure.
They are aggressively buying up GPUs and expanding their data centers in Mahwah, New Jersey. They talked about selling out Hall 5 and moving rapidly into Hall 6. But wait, let me put my skeptical investor hat on here for you.
Okay, let's hear it.
They are spending $850 million on GPUs right now. NVIDIA and AMD put out faster, more efficient chips every 12 to 18 months. Aren't they just setting nearly $1 billion on fire, buying physical hardware that will be completely obsolete by 2028?
The hardware depreciation cycle is brutal, I'll give you that. But the latency and security requirements of financial AI make it unavoidable.
How so?
To understand why ICE is buying bare metal GPUs, you have to look at the architecture of institutional data. When a retail user interacts with a public LLM, they send a prompt to a cloud server, and the model returns an output.
Sure, like using ChatGPT on your phone.
Right. But a Tier 1 bank or a massive mortgage servicer cannot send highly sensitive, personally identifiable financial data, social security numbers, W-2s, trading algorithms out to a public API.
Oh, absolutely not. The compliance departments would have a heart attack.
The data leakage risks and the regulatory fines would be catastrophic.
So the data must remain entirely within a governed, auditable regulatory perimeter.
Exactly. The only solution is to bring the open weight AI models to the data rather than sending the data to the model.
I see.
That is why Hall 5 and Hall 6 and the Mahwah Data Center are completely sold out. Asset managers and banks are desperate for rack space so they could deploy customized AI models directly against ICE's proprietary pricing engines and historical data streams.
With zero latency.
And zero risk of data exfiltration. ICE is effectively building a private, high-performance computing cloud for the global financial sector.
Ben Jackson, the president of ICE, made a fascinating point about this exact dynamic on the call. He said people who think AI will commoditize ICE's software have the entire paradigm backwards.
That was a great moment.
He argued the foundational neural networks are absolutely becoming commodities. But a highly advanced LLM is completely useless without structured context. It doesn't inherently understand the regulatory compliance guidelines for a Texas cash-out refinance, and it doesn't know who holds the legal permissions to view a specific tranche of collateralized loan obligations.
Because an AI model is essentially just a pattern recognition engine. Without a deterministic framework, it hallucinates.
Right.
The true impenetrable moat is not the AI model itself. The moat is the semantic ontology layer that ICE has spent 2 decades building.
The semantic ontology layer, that's a mouthful.
It is, but it just means they have digitally mapped the behavioral relationships, the regulatory constraints, and the complex workflows of the mortgage and fixed income industries. They have the governed network of record.
So when you inject a commodity AI model into a freely structured, heavily regulated ontology, the AI becomes an operational superpower.
Yes, the AI doesn't compress ICE's margin. It dramatically expands the surface area where their network is indispensable.
And they already have traction with this, don't they? They launched IC Compass in the fixed income space, which is an AI-powered pre-trade analytics platform.
And T. Rowe Price is already signed as the anchor client.
Which is huge. Compass uses AI to estimate the optimal quote on a bond before the portfolio manager even submits the RFQ to the dealers,
effectively neutralizing the informational advantage that Wall Street banks historically held over asset managers.
So the monetization of this $850 million CapEx is already happening in real time.
The CapEx is justified by the immediate product deployment. And, they are balancing this heavy infrastructure spend with aggressive operational efficiency. Management guided for $100 million in annualized expense synergies from the market access acquisition by year 3.
$100 million. How do they get there?
They have a very surgical methodology for integrating acquisitions, rationalizing real estate footprints, consolidating back-office corporate functions, migrating legacy databases directly to IC infrastructure, and eliminating third-party vendor overlaps.
All right, looking at the balance sheet and the capital return strategy, this brings us to Section 4. This is where the thesis either holds up or falls apart for you, the retail investor.
The bottom line.
They are funding a $5.7 billion all-cash acquisition by issuing new bonds, taking out term loans, and tapping the commercial paper market. Management expects gross leverage to peak at 3.4 times post-acquisition. Now, for a highly levered financial institution, 3.4x usually restricts your operational flexibility.
Well, if ICE relied on episodic transaction volumes, a 3.4x leverage ratio would be a massive vulnerability.
Because a bad quarter means you can't pay your debts.
Exactly. A sudden drop in market volatility would crush their cash flow, making debt service highly restrictive. But we have to anchor back to that $1.4 billion in quarterly recurring revenue we talked about at the start.
The rent collection.
Yes. That predictable cash flow acts as a financial shock absorber. Management laid out a very clear glide path to deleverage back to 3.0x or below within 18 to 24 months.
Have they done this before?
They executed this exact playbook flawlessly following the Black Knight acquisition. They maintain a fierce commitment to their investment-grade credit rating. And the bond market clearly believes their deleveraging timeline.
But the most aggressive signal they sent wasn't actually about the debt. It was about the equity. Usually, when a company levered at 3.4x commits to rapid debt paydown, they suspend share repurchases.
They hoard the cash.
Right. But IC is doing the exact opposite. They are increasing their baseline stock buybacks from $350 million to $400 million per quarter.
Backed by a newly authorized $4 billion repurchase program.
In Q2, they actually bought an opportunistic additional $300 million in stock because they believed the market was mispricing their equity.
It is the ultimate display of balance sheet supremacy. Wall Street constantly forces management teams to choose a specific narrative. You are either a hyper-growth company consuming capital to fund risky expansion, or you are a mature cash cow harvesting margins to return capital to shareholders.
And ICE is saying, why not both?
They are completely rejecting that binary constraint. Their operational cash flow is so robust that they can simultaneously execute a $5.7 billion cash acquisition in fixed income, pull forward $850 million in data center capex for AI, aggressively pay down billions in bridge financing, and still accelerate the pace at which they retire their own outstanding shares.
That is the mechanical definition of a compounder. So if you are an investor, you are looking at an infrastructure monopoly that consolidates its competitors, walls off its proprietary data sets, and treats its equity as its most valuable currency.
They are engineered to generate compounding returns across basically any macroeconomic state.
Let's test that. If interest rates spike,
Multi-currency rates hedging business accelerates.
if rates collapse,
Mortgage origination volumes explode and Encompass API calls go parabolic.
and if the market goes entirely flat,
They quietly collect their $1.4 billion in recurring data rent.
they are not building technology to capture a momentary trading trend. They are building the structural substrate of the market itself. The architecture is designed to capture value regardless of the asset class or the macroeconomic regime.
It's an incredibly resilient model.
We have to look at what comes next, though, because during the Q&A session, Jeff Sprecher, the CEO, addressed a topic that feels like it belongs in a science fiction novel, but is rapidly becoming a regulatory reality.
Oh, the tokenization comments.
Yeah. He was asked specifically about perpetual futures and the migration of traditional real-world financial assets onto blockchain networks, moving traditional securities on-chain.
Sprecher's analysis of tokenization was highly pragmatic, actually.
What did he say?
Well, he dismissed the immediate threat of blockchains replacing the core matching engines of venues like the New York Stock Exchange, which ICU owns, of course.
Right, because of the speed.
Exactly. Current distributed ledgers simply cannot handle the microsecond latency and throughput required for high-frequency equities trading. However, he zeroed in on the absolute advantage of blockchain technology, settlement, and the movement of collateral.
Because right now, the global financial system operates on an archaic T+1 or T+2 settlement cycle, fundamentally constrained by the operating hours of the U.S. banking system and the SWIFT network.
The friction of banking hours traps trillions of dollars in idle collateral. Think about it. If you want to move capital globally over the weekend to cover a margin call in Asia, you're restricted by correspondent banking latency.
You literally have to wait for a bank to open on Monday.
Exactly. But moving securities on-chain allows for instant atomic settlement and 247 collateral mobility. It bypasses the traditional banking rails entirely.
And Sprecher indicated that ICE is already coordinating with major regulatory bodies and Tier 1 institutions to facilitate this transition, right?
He heavily hinted that we will see significant regulated entities moving traditional assets on-chain within the next 12 to 18 months.
The capital efficiency implications there are staggering for you to think about. If a sovereign wealth fund can instantly post tokenized U.S. treasuries as collateral at 3 a.m. on a Sunday to fund an energy derivative position in London, the velocity of global money completely transforms.
It's a paradigm shift.
But it creates a massive strategic paradox for IC, doesn't it? If they build the architecture for instant decentralized settlement, do they cannibalize their own highly lucrative clearinghouses? Or do they just pivot to becoming the regulated toll-collecting governance layer for the new decentralized financial system?
It is the defining innovator's dilemma of the next decade.
Yeah.
Because if you attempt to protect your legacy clearing margins by resisting tokenization, you risk being bypassed by agile crypto-native infrastructure. But ICE's historical playbook suggests they will embrace a disruption, work directly with the regulators to legitimize the technology, and quietly ensure that every tokenized asset still relies on their proprietary evaluated pricing data and network connectivity.
They will basically rebuild the pipes before anyone else realizes the water flow has changed.
Exactly.
Are they building the technology that eventually replaces them, or are they just pouring the concrete for an even larger, more dominant basement? You know, you can analyze the $1.90 in EPS and the $5.7 billion acquisition all day, but the real thesis on ICE comes down to whether you believe they can maintain their grip on the underlying plumbing as the entire financial system digitizes.
That's the billion-dollar question.
True generational wealth isn't generated by predicting the direction of the casino floor. It's built by owning the infrastructure that keeps the lights on, routes the capital, and extracts a microscopic fraction of a cent from every single transaction. Keep your eyes on the basement. We'll see you next time.